Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at AST SpaceMobile.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine for a second being stranded in the middle of the Sahara Desert.
Okay, not ideal.
Right, or like hiking deep in the Rocky Mountains. And you pull out the exact same, completely unmodified smartphone you use every single day.
Just the normal phone in your pocket.
Exactly. And you just seamlessly stream a 4K video. No clunky satellite dish, no, specialized expensive hardware.
It's just your phone.
Just the phone you already own, connecting to a cell tower floating literally hundreds of miles above your head.
It sounds like sci-fi.
It totally does. But today, we are doing a deep dive into the company actually trying to make that a reality. And, well, the absolute Wall Street frenzy that is currently pricing them as the next global telecom utility.
And the stakes here are, they're truly massive. We were looking at a company that just crossed a major psychological and, frankly, financial threshold.
Oh, yeah, the recent numbers.
Right. They reported their first significant revenue of $70.9 million for the full year of 2025.
Which is a huge milestone.
It is, but they aren't stopping there. The models have them staring down a path that approaches nearly $1 billion by 2027.
Wait, $1 billion?
Yeah, nearly $1 billion. That is a staggering vertical ramp up in an incredibly short amount of time.
Okay, let's unpack this financial inflection point, because going from essentially zero, like a pre-revenue developmental space project, to booking $70.9 million, that is the moment every early stage investor dreams of, right?
Absolutely. It's the turning point.
But wait, if I'm looking at my portfolio right now, how much does that $70 million actually change the underlying thesis? Like, is that just a drop in the bucket for an aerospace company, or does it signal something bigger to the market?
It signals a fundamental shift in their entire identity. If we connect this to the bigger picture, the transition from a concept to actual cash flow completely rewrites how institutional investors value the company.
Ah, I see. It's like a tech startup finally moving out of beta testing and landing its first Fortune 500 enterprise clients, right? But on a global scale.
Exactly. Think about it. When you are pre-revenue, you are a venture capital bet. You are a story.
Selling the dream.
Right. The market values you based on hopes, dreams, and very optimistic PowerPoint presentations.
We've all seen those.
Oh, definitely. But the second you start booking tens of millions of dollars from the U.S. government and major telecom operators, you become a real commercial entity.
The math changes.
The financial modeling shifts overnight. You go from a speculative, binary will-they-survive outcome to a business with measurable cash flows and a verifiable commercial trajectory.
And looking at their financials, there is a number that just jumps off the page, a $1.2 billion contracted backlog.
Yeah, billion with a B.
But I got to push back a little here. A backlog sounds great on paper, but, writing a check or signing a letter of intent is kind of the easy part.
Good point.
Are these contracts actually ironclad? Or can these partners just quietly back out if, say, the first major satellite launch goes completely wrong?
That is exactly the right question to ask. These are definitive, long-term commercial agreements, not just casual letters of intent.
Okay.
The partners have committed capital and resources because they desperately need this technology to work. Now, yes, if AST SpaceMobile utterly fails to deliver the satellites, those contracts can't be fulfilled.
Right, you can't pay for a service that doesn't exist.
Exactly. But from a financial perspective, this backlog acts as a massive insurance policy for their near-term cash flow. It basically tells Wall Street that the demand risk is effectively zero.
Wow, zero demand risk.
Yeah, the customers are already lined up in the cash register. The company just has to actually put the product on the shelf.
Which totally explains their capital allocation strategy, because right now they are prioritizing aggressive reinvestment.
Heavy reinvestment.
They are pouring every available dollar into manufacturing and launching more satellites rather than offering shareholder returns like dividends or stock buybacks.
Which is the right move.
Yeah, I've heard some retail investors complain about the lack of a dividend, but if I'm taking on the massive risk of investing in an early-stage space company, shouldn't I actually be terrified if they started paying a dividend right now?
Absolutely.
Yeah.
At this stage in their life cycle, paying a dividend would be a massive red flag.
It would mean they're out of ideas.
It would signal to the market that management doesn't have high-growth avenues for their capital.
Yeah.
If you were trying to capture a multi-billion-dollar global market, you shouldn't be handing out pennies to shareholders.
You should be buying rocket payload space.
Exactly. Reinvesting every single dollar into the constellation is exactly what institutional growth investors demand to see.
So Wall Street is thrilled by this $1.2 billion backlog, but let's be honest, signing partnerships is just paperwork. The real question that should keep these investors up at night is whether the physics of this actually work. Like, how exactly did a pre-profit space company convince the biggest telecom giants in the world to sign on the dotted line?
It all comes down to their technological moat, the Bluebird satellite constellation.
Which is basically cell towers in space.
Yeah, and that technological moat is incredibly deep. Think about traditional ground-based cell towers. They are severely limited by geography, topography, and the basic economics of laying physical fiber optic cables to remote or rural locations.
It's just too expensive.
Right, the Bluebird constellation removes all of those terrestrial limitations.
Here's where it gets really interesting, though, because when you say satellite internet, the first thing you naturally think of is the competition. You think of SpaceX's Starlink, or even Apple's SOS feature.
Of course.
But how does this actually beat a behemoth like Starlink? Think about how current satellite systems work. You are basically carrying around or bolting to your roof a clunky satellite dish.
Right, the user terminals.
Yeah. You need specialized hardware on the ground to catch the signal from space and then a router to broadcast it to your devices. AST SpaceMobile's massive differentiator is direct-to-device connectivity using standard, completely unmodified 4G and 5G smartphones.
That's the key word, unmodified.
But mechanically, how is that even possible? I mean, how do you bridge a 300-mile gap to a device that sometimes struggles to get a signal in a grocery store parking lot?
It's wild, right? The engineering behind it is a marvel. To have a satellite flying in low Earth orbit, traveling at roughly 17,000 miles per hour, successfully communicate with the tiny, low-power antenna inside the smartphone sitting in your pocket.
It sounds impossible.
It requires something called sophisticated phased array antennas on the satellites themselves.
Okay, stop right there. Phased array antennas, that sounds like something off a military stealth bomber. What does that actually mean for the signal?
Let's break it down. Think of a traditional satellite dish, like a flashlight. To point the beam in a different direction, you have to physically move the whole flashlight.
Right.
A phased array is entirely different. It consists of hundreds or thousands of tiny, stationary antennas packed together.
Okay.
By slightly altering the timing or the phase of the radio waves coming out of each tiny antenna, they can electronically steer the signal beam instantly, without moving any physical parts.
Oh, wow. So no moving parts at all.
Exactly. It's more like a highly targeted, steerable laser pointer. Because they solved this massive hardware problem on the space side, calculating exactly where your phone is while moving at orbital speeds, the barrier to entry for the consumer on the ground is zero.
So you don't have to convince people to go to a store, sign a new contract, and buy a heavy space phone. You just use the phone you already have, which honestly explains the total addressable market. We are talking about roughly 6 billion mobile devices globally.
That's a huge number.
6 billion devices that currently experience coverage gaps, dropped calls, or complete dead zones.
Precisely. And that brings us to the strategic genius of their business model. Instead of trying to build a brand new telecom company from scratch, spending billions on marketing and competing against established giants,
They just partner with them.
they are partnering directly with them. They have secured definitive agreements with over 50 telecom partners globally. We're talking about heavyweights like AT&T, Vodafone, and Teletis, who are bringing this space-based internet to Canada.
Well, wait, why wouldn't AT&T or Vodafone just build this themselves? Like, why split the revenue with a space startup?
Because space is hard. And telecom companies are fundamentally terrestrial infrastructure companies, not aerospace engineers.
Right, totally different skill set.
Exactly. By partnering, AST SpaceMobile instantly solves two of the hardest, most expensive problems in the telecom industry. First is spectrum rights.
Oh, the regulations.
The regulatory nightmare of acquiring radio frequencies in every single country is staggering. By partnering, AST SpaceMobile simply utilizes the spectrum already legally owned by their telecom partners.
That is so smart. And what's the second problem?
Second is distribution. They don't need a massive marketing budget to acquire individual subscribers. The telecoms simply offer the space coverage as a premium, high-margin add-on to their existing millions of customers.
Ah.
A simple text message goes out saying, "Want to eliminate dead zones for $5 extra a month?" The distribution channel is instantaneous.
It's a brilliant Trojan horse strategy. You don't fight the massive telecom monopolies. You make your infrastructure indispensable to them.
Exactly.
So if the physics actually work and they have the biggest telecom players eagerly signing partnerships, how is the broader market pricing in this potential? Because looking at the stock chart, it has been absolutely on fire.
Oh, it's been wild.
We are talking about a massive 238% gain over the past year.
The momentum is undeniable. Just recently, the stock broke out of a consolidation phase, surging 10.84% over just 2 days. Yeah, it established a strong support level, meaning a price floor where buyers consistently step in at $83.91. And it hit a recent high of $97.40.
I'm looking at the technical indicators here, and there's a metric I want you to decode for us.
Sure.
The Relative Strength Index, or RSI, is currently sitting at 68. As an everyday investor, when I hear an RSI is approaching 70, that sounds dangerously close to what technical analysts call overbought.
It does.
Are buyers getting irrationally exuberant here, or are they just chasing the hype?
It's a great observation. Think of the RSI like a rubber band that measures the speed and change of price movements on a scale of 0 to 100.
Okay, a rubber band.
Generally, an RSI above 70 suggests the rubber band is stretched very tight, and the stock might be overbought and due for a pullback.
Right.
Sitting at 68 means there's incredibly strong buyer conviction. Yes, the rubber band is stretched, but in high-growth, paradigm-shifting tech stocks, an elevated RSI can also just signify massive sustained momentum.
So they aren't necessarily about to snap back.
Not always. People are rushing in because institutional acceptance is growing rapidly, and they don't want to miss the boat.
And that institutional adoption is key, right? I see they've recently been included in the Bloomberg 500 index, and it's a major holding in the Roundhill Space ETF.
Yes.
For the listener who mostly focuses on company fundamentals, why does inclusion in a passive index or an ETF matter so much for the stock price?
It creates a baseline of mechanical liquidity. When a stock gets added to major indices or ETFs, it forces passive funds like massive retirement accounts to algorithmically buy the stock.
Regardless of what the news says that day.
Regardless of day-to-day news or fundamental valuations, they have to hold it to track the index. It creates a synthetic price floor and dramatically reduces volatility over time.
And the active Wall Street analysts are definitely taking notice, too. The upgrades are rolling in fast.
Very fast.
Deutsche Bank recently raised its price target to $139. Roth Capital bumped theirs up to $108, and UBS set a target of $85.
Those are significant jumps.
And plus, we can't ignore the speculative market catalysts happening in the background. There is a lot of chatter about the potential halo effect if SpaceX ever announces an initial public offering.
Oh, that would be massive.
Right. If SpaceX goes public, it brings a massive mainstream spotlight to the entire space sector, lifting all boats.
There are also hints of future high-margin classified or defense-related revenue from the U.S. government.
Oh, the defense sector.
Yeah, and defense contracts are notoriously sticky. Once the military integrates your proprietary technology into their communication infrastructure, it provides a highly reliable, incredibly high-margin revenue stream that can last for decades.
Okay, all of that sounds fantastic, but we have to address the elephant in the room regarding their valuation.
Let's do it.
Because right now, the company is trading at a staggering 147 times forward revenue. So what does this all mean? Let me repeat that for everyone listening. Not trailing earnings, forward revenue.
Revenue that hasn't even happened yet.
Exactly. That means revenue that hasn't even been generated yet. That is a sky-high premium. How should you, as an everyday investor, digest a multiple like that without getting immediate vertigo?
It's the most vital question we can ask. A multiple of 147 times forward revenue would be utterly terrifying for a traditional software company or a retail brand.
Right, you'd run for the hills.
But you have to contextualize what the market is actually pricing in here. The market is not evaluating AST SpaceMobile based on its current early-stage profitability.
Okay.
Investors are looking past the growing pains of 2025 and 2026. They are modeling out that near $1 billion revenue projection for 2027 and applying a utility framework to it.
A utility framework, like a water or power company.
Exactly. Think about a water utility. It costs billions to lay the pipes, secure the land, and build the reservoirs. During that build-out phase, the financials look terrible.
Because all the money is going out the door.
Right. But once the infrastructure is built, the ongoing maintenance costs are relatively low, and the cash flows are incredibly predictable and massive. Investors are paying a premium today for the monopoly-like characteristics this global space network will have once the constellation is fully operational.
Which makes logical sense. But,
Yeah.
and this is a massive, but a valuation of 147 times forward revenue leaves absolutely zero room for error.
Zero.
Everything has to go perfectly. And that leads us directly into the fundamental risks and the bear case, because we are talking about space, and the physics of space are notoriously unforgiving.
Incredibly unforgiving. The entire valuation, all those glowing analyst price targets, that $1.2 billion backlog, it all hinges entirely on successfully manufacturing and deploying 45 to 60 satellites into low Earth orbit by the very end of 2026.
That is a tight deadline.
That is the impossibly tight needle they have to thread.
You really have to ask yourself, how much risk are you willing to stomach for a company that literally has to shoot its future profits into space on top of highly explosive rockets?
It's not for the faint of heart.
We aren't talking about pushing a software update over the cloud where a buggy line of code can be patched the next morning. We are dealing with orbital mechanics.
And the operational delays are the biggest vulnerability. First, you have the risk of catastrophic launch failures.
Which happens.
While statistically lower today than a decade ago, the risk of a rocket exploding is never zero. Then you have weather delays. You simply cannot launch in a hurricane.
Right.
But perhaps the most insidious risk is supply chain bottlenecks in satellite manufacturing. Building 60 state-of-the-art massive Bluebird satellites requires thousands of highly specialized components.
So if one part is late.
If a single microchip supplier in Asia runs into a manufacturing delay, the entire assembly line halts and the launch timeline slips. At a multiple of 147 times forward revenue, any slip in the timeline could cause a very sharp, very painful stock correction.
And we can't ignore the competitive landscape. SpaceX has a massive head start in terms of launch cadence and pure capital.
They do.
They own the rockets. They can launch their own payloads whenever they want at cost. AST SpaceMobile has to book a ride, often on SpaceX's own rockets. Isn't that a massive conflict of interest? It feels a bit like Pepsi paying Coca-Cola to deliver their soda to the grocery store.
It is a wild dynamic, for sure. But it highlights a crucial distinction in their business models. What's fascinating here is how AST SpaceMobile has inflated itself.
How so?
Yes, SpaceX has the rockets and their Starlink system. But their technological moat, the ability to connect to an entirely unmodified smartphone, keeps them fundamentally separated from SpaceX's hardware-dependent model for now.
Because Starlink still needs the dish.
Right. Starlink is primarily focused on residential broadband, maritime, and aviation setups where you can mount a dish. AST SpaceMobile is focused purely on the phone already in your pocket.
Let's jump back to the stock chart for a second, because the technical analysts are throwing up a warning sign. They are pointing to potential bearish divergences near the psychological $100.33 level.
Yes, that's a key level.
Bearish divergence is a term that gets thrown around a lot on trading floors, but what does that actually look like on the ground for someone holding the stock?
Great question. Imagine a car coasting up a very steep hill. The car's still moving upward. That's the stock price hitting new highs.
Okay.
But if you look under the hood, the engine is actually losing power and the RPMs are dropping. That loss of power is the underlying momentum or buying volume.
Ah, I get it.
A bearish divergence occurs when the price makes a higher high, but the momentum indicators make a lower high. It suggests the upward trend is exhausting itself.
So the car might roll backward?
Exactly. If the stock can't decisively clear that $100 resistance level with strong volume, short-term volatility and a price pullback are highly likely.
Okay, so we clearly see the massive upside of becoming a global utility, and we know the terrifying risks of orbital rockets and supply chains. Let's outline the catalyst calendar.
Let's do it.
What exactly do investors need to be watching over the next 3 months to verify if this company is actually staying on track?
The single most critical near-term catalyst is launch news. The market is currently pricing in that aggressive 2026 launch schedule.
Right.
Any official announcements regarding a firm specific launch date for the next batch of Bluebird satellites will act as an immediate positive driver. Conversely, silence is the enemy here.
Because silence implies a delay.
Yes. Investors need constant reassurance that the payload is actually moving from the factory floor toward the launch pad.
And beyond just getting them into the sky, we need to watch for news regarding the official switch on.
The commercial launch.
Yeah. That's the transition from merely turning the satellite on and doing internal engineering tests to actually providing broader revenue-generating commercial service in key initial markets like the United States and Europe.
That's the real test.
The day a major telecom partner like AT&T officially announces to their customers, "You now have space coverage," is the day the speculative financial model becomes a concrete reality.
We also have to keep a close eye on macro trends, specifically interest rates.
Always interest rates.
A stabilizing or lowering interest rate environment is incredibly beneficial for high-growth, pre-profit stocks. When we talk about discounting future cash flows, it means that money earned in 2027 is worth less today because of inflation and the opportunity cost of not having that money now.
Okay, sure.
When interest rates drop, the penalty applied to those massive future cash flows also drops, making those future billions worth significantly more in today's valuation.
Which raises the ultimate question of timing. I mean, trying to day trade this stock around a specific rocket launch seems like a fantastic way to lose sleep and money.
This raises an important question, right? Extreme volatility around these specific launch milestones is an absolute given. The stock will swing wildly based on a cloudy weather report or a pre-launch static fire test. But if you are investing based on the fundamentals we've discussed today, the focus must remain strictly on the long-term infrastructure value being created.
You aren't trading a rocket launch.
Exactly. You are investing in the foundation of a future global network.
Which brings us to our final synthesis. When we look at the totality of the financials, the sheer brilliance of the technological moat, the aggressive market sentiment, and the very real, very explosive risks of operating in space, AST SpaceMobile earns a highly bullish score of 8 out of 10.
I agree with that. It is fundamentally viewed as a multi-year hold. This is not a quick flip for a day trader.
Not at all.
It offers incredible asymmetric upside if and only if it can successfully execute the manufacturing and deployment of its constellation, unlocking those multi-billion-dollar commercial revenues by 2026 and 2027.
They just have to execute.
The pieces are all on the board, the telecom partnerships are signed, the technology has been validated in testing. Now it all comes down to flawless execution.
It is the ultimate high-wire act, taking place hundreds of miles above our heads. And as we wrap up today's deep dive into this incredible transition from a speculative idea to a commercial reality, I want to leave you with a final lingering thought to ponder on your own.
Okay, let's hear it.
We've spent a lot of time breaking down the technology, the antennas, and the stock price multiples, but zoom out and think about the geopolitical and societal implications here.
It's huge.
If a single company successfully builds a universal network that connects directly to any standard smartphone anywhere on Earth, regardless of mountains, oceans, or borders, what happens to the concept of national telecom sovereignty?
Oh, wow.
Could a globally accessible space-based infrastructure eventually make our traditional ground-based network monopolies completely obsolete?
It's a technological paradigm shift that could literally rewrite how the entire world communicates.
Something to think about the next time you look down at your phone and see absolutely 0 bars. Thanks for joining us, and we'll see you next time.